Welcome back to Frame Wealth Partners, and today in this video we'll discuss inflation and its impact on your investments and financial goals. Look folks, inflation affects us all in different ways. Think of it like natural disasters. You've got earthquakes that are sudden, dramatic, and messy. And you've got erosion, which is slow, sneaky, and steady. Both can do serious damage if you're not ready. Money works the same way. The hardest challenges families and businesses face aren't always dramatic stock market crashes. Sometimes it's the slow drip of inflation. Your dollar's buying less and less over time. Today, we're seeing both dynamics at play, making it crucial for investors to understand how to position their portfolios for various scenarios. Let's take a look. Let's start by looking at how inflation has eroded purchasing power over the past century. If you look back over the last century, what cost $1 in the 1920s cost about $18 today. That's inflation at work. And even when it seems low, say 2 to 3%, those little increases add up. At 3% inflation, the cost of living doubles about every 24 years, which conveniently is the length of a typical retirement. So, unless you plan on living off of a strict diet of ramen noodles in retirement, which I highly don't recommend, your money has to grow faster than prices rise. Now, you might think that zero inflation or even deflation where prices fall would be helpful, but modern economic theory tells us that a low but positive inflation rate, usually around 2%, actually creates the best balance for individuals and the broader economy. This moderate level gives central banks room to implement monetary policy and helps prevent deflationary spirals where consumers delay purchases expecting lower prices in the future. So what's happening with inflation today? Recent reports show that inflation continues to be stickier than many would like. The latest producer price index jumped almost 1% in a single month, the largest increase since June 2022. This matters because increases in wholesale prices often show up in the consumer prices with a lag of several months. We're seeing this play out as companies that initially absorbed costs from tariffs may now be passing higher prices on to consumers. Now, the Consumer Price Index shows prices rose 2.7% over the past year, or 3.1% when excluding food and energy. Much of this increase came from rising housing costs. Although inflation is stickier than expected, it's also not at the double-digit levels experienced in 2021 and 2022. Still, it's important to hold a portfolio that can withstand both sudden and gradual inflation. And here's the challenge. Inflation isn't just about higher grocery bills. It's about what it means for your cash and savings. Cash, even in money markets, doesn't always keep pace. In fact, short-term interest rates have come down, but Americans are still parking a record $7.1 trillion into these accounts. Meanwhile, history shows that both stocks and bonds have outpaced inflation over long periods. Stocks can be volatile during inflationary periods, as we saw in 2022, which is why maintaining a balance of asset classes that can withstand both inflation and volatility is so important. Key term here is diversification is your friend. Ultimately, it's important that long-term investors resist the urge to make dramatic portfolio changes based on individual data points. While it's crucial to ensure your portfolio is positioned for different scenarios, overreacting to short-term data often leads to decisions that are counterproductive. Let's not make knee-jerk reactions. Depending on your personal goals, holding the appropriate portfolio that can generate both income and growth remains the best way to achieve financial success. We hope you found these insights helpful. If you'd like to learn more about how inflation might affect your specific financial situation or discuss your portfolio position, please don't hesitate to reach out to us here at Frame Wealth Partners. We look forward to speaking with you. Take care.